Great. So, ladies and gentlemen, here we are looking at cash flow statement according to IAS 7. We started by making a mention here that we have got two major methods of preparing cash flow statements, which are recommended by IAS 7. And as we begin this particular journey, ladies and gentlemen, this notwithstanding the two methods, indirect and direct, for us to be able to explain this very well, you need to know straight away that there are three major activities that the standard wants you to mention whenever you are preparing a cash flow statement of your organization. So they want to know, out of your operations, your sales that you are doing here, how much cash flow are you able to raise? Operating activities. And then we have what we are calling investing. Of course, any good organization like RCM Online College, we have our own investments. We are investing, for example, in treasury bills. We are trying to put up, for instance, a hostel, right, somewhere. So out of these investments, which are not even connected with our primary duty, remember our core activity here is to teach. From the revenues that we are getting from our students here, then we are able to ensure that our operations are running. So revenues we get, sales we get, of course, these will go under the operating activities. But again, for purposes of diversifying our risks and the revenue streams, it will be important for us to, whenever we have some surplus cash, we think of putting this money in shares of other companies. Putting this money, for example, some of it in real estate. So we must invest. Right? Very important. Buying, in this case here, property, plant, and water equipment. That's an investment. You're looking at your future, etc. Now, again, ladies and gentlemen, the last one, of course, for us, at times, these operations, ladies and gentlemen, may not be able to give you sufficient cash to run your operations. All right? So then you may need to look for finances from outside there. So we would want you to come and give us the cash flows arising out of financing activities. And I was explaining, ladies and gentlemen, here that whenever you hear of financing activities, we are looking at the capital structure. How is the capital of this organization structured? We said we have debt, we have equity, and in some cases, as you shall see from our past papers, we have what we call preference shares. We have what we call preference shares. So when we talk of financing activities, we shall be seeing the debt, the long-term borrowings, the long-term loans. Did they increase? If they increased, it means that you went to a bank to borrow more loans. So then that means what here? A cash inflow, right? The same case in this case here with the equity shares. So if, for example, in 2020, our equity shares were worth 10 million. And then 2021, our equity shares are worth 15 million. Can someone try to interpret this for me? 2020. Our equity share capital was worth 10 million. In 2021, the same equity share capital class is now worth 15 million. How would you interpret that increase? How would you interpret that increase of shares? There are very many students who are having their videos on. I would have loved to have them on really, but you see, there are students whose bandwidth is too low. So you really get to affect them. You really get to affect them whenever you have your videos on. Great. Thank you very much, Jackie. Jackie has known that when equity share capital increases, it means that you issued new shares in the period. There is a movement. You issued new shares in the period. So automatically, ladies and gentlemen, it means a cash inflow. We got an extra 5 million Kenya shillings. So the 5 million that you got extra there will be accounted under who? Under the financing activities. Under the financing activities. Now, ladies and gentlemen, I would want to share some notes with you here, which are great notes that I would want to share with you for purposes of you picking this thing very fast. And please try to be very attentive because this will be a 1 hour class. 1 hour class. This shall be a 1 hour class, not more than 1 hour. Not more than 1 hour. Not more than 1 hour. So try to be very attentive. Otherwise, you will not benefit a lot. You may not benefit quite a lot. Great. So please let me know whether you are able to see my screen. Are you able to see my screen? 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 Please talk to me in the chat section. In the chat section, please talk to me in the chat section. In the chat section, please talk to me. Are you able to see my screen? Yes, I can see here. Yes, thank you very much. Now, I'm looking at the basic steps and I'm going to start with the indirect method. Indirect method, ladies and gentlemen, does not start with the revenues you generate in the operations. Indirect method, basically we start with profits and then we work backwards to generate cash flows. So you're saying indirect method here, the idea is simply to get to the profit from operating activities as a starting point. Nothing more. It's a very easy thing. So IAS tells us that although we need to get to the operating profit figure, we must start with the profit before tax. So we must start with the profit before tax. So please don't make any notes. I'll be able to share these notes with you as we normally do in the online classes. We share notes with our students immediately after the class. So we are being given a recommendation here by IAS 7 that we should always start with profit before tax if you're using this indirect method and reconcile this to the operating profit figure. Now at this juncture, I would want somebody in this case here to try telling us what they understand by this particular terminology, operating profit. What is operating profit? 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 Can somebody tell me? EBIT, Shakoma. Thank you very much. This must be a very good student. Anytime we talk about, ladies and gentlemen, anytime we talk about operating profit, we are looking at the profit before interest and the tax. So IAS tells us, fine, start with profit before what? Tax. But ensure that you reconcile it towards what? The profit before interest and tax. This is what we are calling the operating what here? Operating. This is what we are calling the operating profit. Operating profit. So whenever you talk of operating profit, this is PBIT. What have they told us? I'm repeating again. What these guys have told us, ladies and gentlemen, here is quite a simple thing. They have told us that IAS tells us that although we need to get to the operating profit figure, we must start with profit before tax and reconcile this to the operating profit figure. Now, operating profit, before we do this, let's remind ourselves what operating profit is. So operating profit, according to these people, they have told us that we should take sales, cost of sales, administration expenses, distribution expenses. You subtract these three from your sales to get profit before tax and before interest. So you don't charge tax, don't charge interest. And these guys are great. They're great as the cow that I'm seeing here trying to write something at the end of the day. This cow is going to be very clever. They have given us, ladies and gentlemen, some illustration here. They have given us sales of 1,000. Cost of sales, hypothetically, they have a figure of 400. Administration like that. Then we have income from investment property, which is 180, it's positive here. Then we have the distribution cost, we have the finance cost, we have profit before tax of 500, we have tax of 50 bob. Now, so start with, these guys are great. They're giving us quite a very good illustration. And they're telling us, the way IAS 7 tells us, always start with the profit before tax figure, and then reconcile to the operating profit figure. To the operating profit figure. Now, I would want to see whether I have a very good student in this room who will be able to give me the operating profit from this information given, From this information given, take your calculator and then you say ta like this, you press like that. Tell me the operating profit is this much. Let me see who will be able to get this correct. Operating profit will be how much? Operating profit will be how much? Operating profit will be how much? The operating profit will be how much? I'm waiting to see who will be the first guy from what we told them up there, will be the first guy to give us the operating profit, will be the first person. We should be able to reward that person. Yeah, they're saying, somebody is saying 400, somebody is saying 500, Masisimu is saying 580. Let's see. Catherine is saying 400. Galaxy person is saying 580. 580 seems to be getting quite a lot of what here, traction. 580, 580, 580. Marietta says 320. Thank you very much. Sharon, 400. You guys are great accountants. You're great accountants. Charity, 500. Ladies and gentlemen, let's try getting this. Let's see what the examiner has here. So remember, I gave you a formula up there. I told you to get operating profit, you take sales, cost of sales, administration expenses, distribution costs. If you take 1,000 minus this, you will be able to see straight away an operating profit of 400. Because up here, if you remember, up here, I gave you the format of getting operating profit. Do you remember this format? Sales, less cost of sales, less administration expenses, less distribution cost. Are you able to remember this format? 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 They have forgotten the format. They have forgotten the format. So then are we in agreement that the correct answer is supposed to be 400? Are we in agreement that the correct figure is supposed to be 400? And I know really where most of us went wrong. I know I've been in this business every day. This is what I do at my workplace. I'm an accountant, right? A group accountant for that matter. So I do these things every day. So you must get somebody here in this room who included inappropriately the investment income under operations. No. Investment income is an income that should be accounted in a different section. Remember, we have investment activities that should be accounted for under a different section. Here we are only looking at how much are we able to generate from sales and what expenses are we supporting with our sales. That alone. So again, I'm asking for feedback whether all of us have understood how the 400 came about. Because if we don't understand that really, we should not continue with this session. Yeah, 400. Thank you very much. Thank you very much. Thank you very much. Now we continue. Now, ladies and gentlemen, now let's start reconciling. So the reconciliation that these guys want you to do, they want you to start with the profit before tax. Profit before tax, profit before tax, this 500 here. They want you to start with the profit before tax, and then you work now backwards until you get operating profit. Let me give you 1 minute and we see whether there is anybody who will be able to reconcile so nicely. Let's see whether there is anybody who shall be able to reconcile so nicely before I start doing something. Let's see. Is there anybody who will be able to? Is there anybody who will be able to? Is there anybody who will be able to really do a reconciliation? According to IAS 7, we need to start with PBT, and then we work backwards to operating profit. I'm giving you again 2 minutes. Don't get tired with my many tasks that I'm giving you. It's my way of teaching. It's my way of teaching. So if you're able to reconcile, if you're able to get that 400, could you kindly say why for yes? If you're able to reconcile, could you kindly say why for yes? And if you're not able to reconcile, it's not your mistake. You simply say, and for no, I'm not able to reconcile. That's life, you know. That's life. I'm not able to reconcile, mwalimu. Right? Right? I'm not able to reconcile, and then we talk. And there is only one person called Rosie who has been able to reconcile. Thank you very much. Thank you very much. Ladies and gentlemen, I would want you to listen and listen to me very well. For this person to have gotten this 500, wamefanya madhambi. According to International Accounting Standard 7, these guys, for them to have gotten this profit before tax, kuna madhambi ambayo wamefanya. For example, we'll subtract finance cost. Na hapo wanafaa kusubtract finance cost. Hakufaa kusubtract finance cost. So then what should we do with this finance cost, ladies and gentlemen, that was subtracted in by mistake? By mistake. What should we do with this finance cost? What should we do with it? What should we do with it? Because finance cost has been subtracted to arrive at that 500. And we know that according to IAS 7, we are not supposed to subtract finance cost. When getting the operating profit, we should not do that. So in this case here, they subtracted. So for us to cancel that mistake, ladies and gentlemen, we need to do what? We need to add back. We need to add back. Thank you very much. Also, for them to have gotten this profit before tax of 500, there is one issue here. I don't have a problem with sales. Sales is okay. Cost of sales is okay. Admin is okay. Distribution is okay. But I have a problem with this income from investment property. It should never be part of our operating profit. Now that I would want to cancel that particular issue that has happened here, what should I do with this investment? I can see here they added. So to cancel that, what should I do myself, ladies and gentlemen? Now I need to come and what here? Deduct. Now I need to come and deduct. I need to come and deduct. I need to come and deduct. And you can see, ladies and gentlemen, what they have here. They have something very nice. They have something very nice for us to be able to get the operating profit. Thank you very much. What they have done, they took the profit before tax from that statement of 500 or 500. And then they came and said, fine, I want this to be PBIT. I want it to be profit before interest and or tax. Now that these guys have already subtracted interest and they should not have done that, I need to come and cancel that, correct that. So I need to come and say here, add interest. Remember, interest is what they are calling what here is what they are calling finance cost. So the interest, ladies and gentlemen, that we have there, the interest that we have there is how much? The interest we have there is how much? It's 80. And then to arrive at this figure, these people have done a mistake. They had put in some investment income which was positive. So I need to cancel it out of this. So I need to come and say less what here? Less investment income. Investment income of how much? I can see it is 100 what here? 180. So the moment I do that, ladies and gentlemen, then I should be able to get my famous operating profit, which is PBIT, which is PBIT. Now, ladies and gentlemen, first of all, give me the figure. What figure are we talking about here? PBIT, the operating profit is supposed to be how much? The operating profit is supposed to be 400. It's supposed to be 400. It's supposed to be 400 like that. So I would want to take some feedback again. Up to here, are we together? Because up to here, are we together? 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 Yes. Thank you so much. Thank you so much, Steve. Great. Now, ladies and gentlemen, we continue. Now, what are they telling us here? That you shall place this in the cash flow from operating activities, part of the cash flow statement. We shall see how that works. We shall see how that works. So step number 2. Now we go from operating profit to getting operating cash. Can somebody in this case here remind us what is the difference between profit and the cash flow? What stands in between profit and the cash flow? What stands in between profit and the cash flow? Are they the same? Are they the same? Expenses, no. No. Yeah, depreciation. Changes in working capital, I love that. Non-cash items, non-cash items, non-cash items, and the working capital changes. You guys are very bright. It's non-cash items and the working capital changes. Working capital changes, non-cash items, and the working capital changes are the ones that normally will be in between. If I were you and I'm writing up a few notes here and there, I would have written there expressly that when I'm reconciling operating profit to cash flows, I need to consider the non-cash items and the working capital changes. Those two things. I need to consider the non-cash items and the working capital changes. Thank you very much. You guys are bright. Thank you very much. Now, when you talk of non-cash items, what comes in this case here to your mind? Non-cash, they are actually even listing them there right now. The non-cash items, what comes to my mind? Non-cash items, what comes to my mind? Non-cash items, what comes to my mind? And cash items, what comes to our mind? Thank you so much. Thank you so much. So we have depreciation is key. Is key. Number two, we have amortization. I've seen it there. Thank you so much. Any other? Impairment of goodwill. You know, Eric, you can't take goodwill the way the whole of it to the income statement, really, no. It's the impairment. Impairment of goodwill. Thank you so much. We have disposals. When you dispose assets, you will either get a profit on disposal or a loss on what year? Disposal. This profit or loss on disposals, they are fake. They are non-monetary. They are fake. They are fake. They are fake. They are fake. Thank you so much. Thank you so much. So the talk of gain on disposal, for those ones who we shall be doing the group cash flow statements, we shall be looking at, for example, the gain or loss on disposing what here? A subsidiary. We'll come to that later. Right, great. How about, ladies and gentlemen, working capital items? Is there anybody who knows anything to do with working capital items? Is there anybody who knows anything to do with working capital items? What do we have there? 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 Yeah, even revaluations. Thank you very much. So we have in working capital, ladies and gentlemen, working capital items. Tuko na ya kwanza ambao ni inventory. Ya pili ni gani? Somebody ya pili automatically ya pili tuko na receivables, and then the third one, ladies and gentlemen, is the payables. The payables like that. Great. Thank you so much. Now listen and listen to me very well here. Listen and listen to me very well here. Listen and listen to me very well. So you're told here, now we go from operating profit to getting the operating cash. We do this by taking the profit figure, calculated and reconciled in step 1, the PBIT, and adding back all the non-cash items. We get to the cash, therefore, indirectly. We get to the cash, therefore, indirectly. Key points to remember here. The non-cash items we add back are only those in the operating profit. The sale, cost of sales, administration, and distribution cost. For example, depreciation, amortization, any impairment, profits on sale, receivable, payables, and inventory. Basically, these three are what we call the working capital changes. There could be more. It depends on the question. But dealing with these will ensure you pass. That is what I spoke about, the concept of what here? Low-hanging fruits. Low-hanging fruits. Ladies and gentlemen, tell you my story a little bit. When I was a student in CASNEB, student of CASNEB long time ago, I got 6 awards. And some of these awards I was getting, of course, they were Financial Accounting 3, Financial Accounting 4, using those old names before they renamed them to Financial Reporting, etc. And I never got to balance any question. I never balanced any question, right? The only good thing that I got to know quite early about financial reporting is that number one, you just need to know how to harvest low-hanging fruits. Low-hanging fruits. And then number two, speed is of essence. You'll get, like when I'm invigilating, when I used to invigilate when I was still a young man, you'll get a good student who knows advanced financial reporting, who knows financial reporting of intermediate level. But this guy goes and spends 1.5 hours doing a group consolidation question. The moment you spend 1.5 hours, ladies and gentlemen, the moment you spend 1.5 hours, ladies and gentlemen, right, in one question, trust you me, you will fail. Because by the time you're getting to look at other questions here and there, then you'll get, in this case here, the examiner ringing the bell, right? Ringing the bell like that, right? That will be automatically what here? An international disaster for you. An international disaster for you. International disaster for you. So we need to understand the exam technique, which I'll be teaching you later on. Great. Now here we are. Now, ladies and gentlemen, you can see the format these guys have given us. They told us IAS 7, start with profit before tax. If there is any investment property income, subtract it. Finance cost, in this case here, it has been subtracted up there, so you add. And then if there is any depreciation, you have to add back. These are non-monetary amortization, add back impairment, you add back. If it's profit here, as we shall be seeing, if it's profit here, what do you do? Profit which has been added there, you subtract, etc., etc., etc. And ensure that you get the signs right. The signs I'll be able to show you how to work with them. Don't even bother with this. This is quite a lengthy explanation. These are lengthy explanation. Now we want us to look at a practical question. Are we ready for a question now? Are we ready for a question? Can we tackle a practical question now? Great. Thank you so much. Now, ladies and gentlemen, I happen to be having some question with me here. Nice question with me. I'll share this book with you, so you should never be bothered at all. Don't be bothered at all. So I have this question with me here. All right. This is the question that I've been given. So they're telling me the following information relates to Geofrost, a limited liability company for the year ended 31st October 07. Extracts from the statement of profit or loss for the year ended 31st October 2017 are as follows. So we have here finance cost, investment income, we have profit before tax, then we have less tax, then we have profit for the year. All right. So they want me to prepare the statement of cash flows for the year ended 31st October 07 for Geofrost. And I would want us, ladies and gentlemen, to start right away with the indirect method. Indirect method, I may not remember many things, but I always remember that when I'm writing down my operating activities, I must start with profit before tax. I may forget about everything else, but I have to start with my operating activities. So I have to start with here, my operating activities. So we have operating activities. So of course, I know you guys are very good in writing the titles. I've never seen any student doing this high level, missing out on the titles. They know how to write Geofrost Limited, statement of cash flows, etc. blah, blah. That one I know you know. So straight away, I'll embark on the area that you're not very good at. So we start with the first section, which is the section of what here? Operating activities. So under operating activities, I shall start with the profit before what? Tax always. always. I'll start with profit before tax. Profit before tax. So have they given me the profit before tax? Have they given me the profit before taxation? Have they given me the profit before taxation? Have they given me the profit before taxation? Profit before tax. Have they done that? Profit before tax. Before we look at our past paper, Sharon says very first, 15,000. 15,000. 15,000. So profit here is before tax is 15,000. Now, ladies and gentlemen, I need to come very fast here and do some adjustments. I need to come and do some adjustments very first. Which adjustments do you think should I do very fast? You guys are now bright. Actually, without you knowing, we have already finished this concept. We have already finished this topic. The easiest topic in CPA. I started by telling you that if you don't get this topic nicely in an exam, then you are also another one. It's normally the easiest. So profit before tax, I look up. So when I look up, what am I supposed to do? I know what I'm supposed to do very fast. Thank you very much. I can see these answers are coming. I can see these answers are coming. Before depreciation investment, before that, we add back finance cost. Thank you very much. Add finance cost. So add finance cost. So finance cost of how much? Finance cost of how much? Finance cost of how much? Finance cost of 400. You can see they are deducted as we are doing the opposite really. So 400 there. Thank you so much. And then somebody has told me that come and less in investment income. Less in investment income. So less investment income over how much? Less investment income over how much? Less investment income over how much? 180. Thank you so much. So you're subtracting this one. Yes. So now at least having done those two great things, I think I'm in a very good position of knowing that I've been able to get what I would have called operating PBIT, right? But now remember, there are those non-monetary items I need to come and do adjustments. Don't add first. Nancy, don't add. Don't add at the back of my mind. Now we straight away go to the non-cash item. Now you're trying to derive profit to cash flow. Let me hang the question here for you to be able to guide me. So then what will be the next thing to be done here, ladies and gentlemen? This is the question here. Right? This is the question here. All right. So depreciation must have been charged up there. Depreciation must have been charged. This depreciation of 46.58 must have been charged up there. So what should we do? What should we do with depreciation? Add depreciation. Thank you so much. So add depreciation. I should not be talking a lot because, ladies and gentlemen, you guys are the experts here. So add depreciation. So depreciation of how much? Of 46.58. Remember, figures here are in terms of thousands. So it should be add depreciation of 46.58. 46.58. Is there any other non-monetary item that you guys are able to see very first? Is there any other non-monetary item that you guys are able to see very first? Is there any non-monetary item that you guys are able to see very first? Now I should keep quiet for some time and see whether my students are really cracking up their heads. Are they cracking up their heads? Right? Actually, even what I need to do is to keep quiet a little bit. I give them 5 minutes up to 9 p.m. to see whether there is anybody who will be able to give me the cash flow from operating activities. 5 minutes. Let me just keep quiet a little bit and see whether there is anybody who has gotten this concept here. And the person will be able to give me the cash flow from operating activities. I will really be very happy. The correct figure there. I'll be so happy. So I only want the final figure. I want now the final figure so that I can know what to do next. Yeah, the cash flow figure. And the cash flow figure. Cash flow from Galaxy 19158. 19158. Thank you so much. Thank you so much. This 19158 seems to be the correct one. It seems to be the correct one. So 3 more minutes, 3 more minutes. I would want to see whether all of them are getting the same. 3 more minutes. Three more minutes, 3 more minutes, 3 more minutes. Three more minutes. One more minute. 1 more minute. Lilian Kadimar. Great. So we have added depreciation there. Thank you so much. Now from there, ladies and gentlemen, let's move slowly here. Let's move slowly here. Thank you so much for getting involved. So what do we have? Apart from this depreciation, I can see that there is some not loss, but profit on disposal. This profit on disposal there was done what here the profit on disposal, ladies and gentlemen, had been added to our profit. That is what IS1 tells us, had been added to the profit. So we need to come and deduct it. So come here and less profit on disposal. So less profit on disposal. So less profit on disposal of 720. So what you do, you'll come and leave some 2 or so lines. Don't be very mean. And then you come and give us still and operating activities. When you are operating, of course, there will be collections of money, right? From your receivables. Payables are also being paid there, right? So in this case, you leave like 1 or 2 lines, come and give us working capital changes. Working capital changes are the ones who gave me the 3 things. The 3 things that you guys gave me, which fall under working capital, we have inventory, we have receivables, we have receivables, and then lastly, thank you, Sharon, we have payables here. Thank you so much. We have payables. So remember, for working capital changes, it is basically the movement where you take the opening balance and the closing balance and see the growth or the reduction. So we start, ladies and gentlemen, with inventory. We start with inventory. So inventory, I'm seeing inventory here under current assets. I'm seeing inventory. Remember, this is the first year. This is the opening year. This is the closing year. So, ladies and gentlemen, for inventory, what am I seeing for inventory? For inventory, what I'm seeing here is that at the beginning, we had 96.35, right? And then we ended up with 35.60. So can somebody in this case here try to explain to us? Can somebody in this case here try to explain to us? Is this a cash inflow or a cash outflow? Ladies and gentlemen, in this case here, remember when we started the year, we had inventories worth 96. The opening balance for inventory was 96.35, but we closed them in our current year. The closing inventory is 35. What here? Somebody is 35.60. Is 35.60. So I can see vividly that there is what here? There is a reduction. I can see vividly my inventory reducing. So in this case here, could you kindly give me the change? Kindly give me the change. Give me the change. Give me the change here. The change. Thank you, Steve. Yeah, the change, somebody has already given me this figure. It is 60.75. And somebody is telling me that this inventory reduced. So it's a decrease. So when an inventory decreases, what does it mean? They sold. So when they sold, automatically that becomes a cash what? A cash inflow. So this 60.75 is a cash inflow. Is a positive figure. Right? How about receivables? Ladies and gentlemen? When I look at my receivables here, I can see we began with, remember this is 06 and this is 07. We began with 45.42. We began with 45.42. And then in this case here, this is the beginning. And then I can see the end figure of receivables is 64.05. 64.05. So could you kindly give me the change? What is the change? The change. Give me the figure, the difference. The change. What is the change? It is 1863. Thank you very much. 1863, and then I can see that my receivables grew. My receivables became bigger. So when receivables become bigger, what does it mean? You are selling goods to them without getting money from them. It's like you're giving them money, isn't it? Right? When receivables increase, what does it mean? Ladies and gentlemen, I've got very many. Yes. They sold goods on credit, yes. It's an outflow. I've got very many ways of knowing what I'm supposed to do here. Somebody told me something very nice that I've never forgotten up to date. That if this is a receivable, the receivable is an asset. When receivables increase, what are we supposed to do? Assets. If you remember your basic accounting, we used to say pairs. Pairs, we said purchases, expenses, assets. Whenever they increase, you debit. Revenue, liabilities, share capital. Revenue, liabilities, share capital. Whenever they increase, you credit. Assets. Whenever an asset increases, you debit. Listen, here receivable is increasing, and because receivable is increasing, ladies and gentlemen, then straight away I should come and debit the receivable. And then of course for purposes of cash flow, remember the other account is cash flow. So if I'm debiting receivable, the other available account is cash flow. I'll come and credit the cash flow. So crediting cash flow means what? That cash went out. cash went out. So in this case, ladies and gentlemen, listen and listen to me very well. Receivable increased. So the other account, which is cash must have gone out. So in this case, it is 18 what here 63 is supposed to be negative like that. Listen, allow me to go back to inventory. Allow me to go back to inventory. Inventory, what happened with the inventory? What happened with the inventory? What happened with the inventory? Inventory is an asset and it decreased. Listen, inventory is an asset and it decreased. So if it decreased, then to show reduction, I'm supposed to come and credit inventory account. Of course, you don't have inventory account in practice. This is just something small to help you remember. So I'm supposed to come and credit inventory account. So if I credit inventory account, remember there are the sister account, and the cash flow statement is always the cash flow or the cash itself. So if I'm crediting the inventory, then straight away I should debit here the cash. So when I'm debiting cash, what does it mean? Cash came in. It's an asset. So that is why in this case here, inventory decreased and we've been able to debit. We've been able to have this as a cash what here, as a cash inflow. Listen, look at the payables, ladies and gentlemen. Look at the payables, ladies and gentlemen. So for payables, what do I have here before I explain this better? I haven't explained it better. I'll explain this thing better. So for payables, if you look at the current liabilities, we have trade payables. Trade payables, I can see what is the difference here, somebody, 75, 62, 43, 64. What is the difference? Can somebody give me that difference? Of course, I can see my payables. I can see my payables increasing. 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 And the increase I'm being given here, the increase that I'm being given here is 31.98. So when payables increase at your place of work, when payables increase at your place of work, what are you supposed to do with the payables account? Are you supposed to credit it or debit it? At your place of work, I'm so sure you guys are accountants. When payables increase, what are you supposed to do in the payables account? Credit. Thank you very much. Credit it. Credit. So then if I'm crediting the payables account, which account am I supposed to debit in this context? In this context of cash flow statement. Which account am I supposed to debit? Don't use bank here. It's cash flow. It's cash flow. It's cash flow. For us, it's cash flow. So, ladies and gentlemen, because of that argument, are you able to see straight away, ladies and gentlemen, that here the payables find they increased, but because of the increase, I'm supposed to receive this as a cash inflow because I'm debiting the cash flow. I'm debiting the cash flow. So in this case here, the cash flow, ladies and gentlemen, that I'm supposed to debit, that figure flew up very fast. Could you kindly remind me the figure? How much? How much are we supposed to talk about here, somebody? 31.98. Now, ladies and gentlemen, whatever I've been giving you here is nonsense. This nonsense, let me rub here. Normally, whenever we talk of working capital changes, I'm always supposed to remember that it is payables, which is the commanding officer. Payables is the commanding officer. Payables, if you're not able to pay these guys, there's a problem. So for payables, we normally remember this, that payables is commanding officer. Commanding officer means what? That you take the closing minus opening. You take the closing minus opening. Could you kindly go to the payables and give me the closing amount? Please go to the payables and give me, the closing amount. Remember, the closing will be for the current year. The closing amount is how much? The closing amount for payables, it is 75.62. It is 75.62. So it is 75.62 minus the opening. The opening, which is 43.64. Opening, which is 43.64. So if you subtract, what figure are we getting there, somebody? When we subtract, what figure are we getting here, somebody? We are getting 31.98, and it's positive, isn't it? So I'll not be able to think at all. I'll not start reasoning again that this has done what, debit what. That's nonsense. so long as I'm able to remember commanding officer in the military language. So this 3198 is positive. I'll come and book it here as a positive figure, like that. So remember, it is only payables, which is the commander, commanding officer. The others are OC opposite. So like in inventory, these two, this is an OC fee, this is an OC fee. It's only payables, that is what here, CO. So meaning that for inventory, I'm repeating this again. For inventory, what should we do? It is opening minus what here? Minus, perhaps you could write this in full. It's opening minus closing. It's opening minus closing. So could you kindly go to the inventory and give me the opening amount? Hey, you great students of mine. Could you kindly go here and give me the opening amount of inventory? Opening amount of inventory. Opening amount of inventory, opening amount of inventory, opening amount of inventory. They are not now talking to me. They are not talking to me. I don't know why. They're not talking to me. I don't know why they're not talking to me. They're not talking to me. Opening is now for the earlier year, isn't it? So the opening here will be 9635. 9635 minus who? 9635 minus who? 9635 minus 3560. Minus 3560. So could you kindly give me this figure? Could you kindly give me this figure? Kindly give me this figure. 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 They're telling me it is 6075 and it's positive. So if it's positive, I'll simply come and put there 6075. It's a cash inflow. I don't have to reason at all. So from there, go to the receivables and use the OC principle. Go to the receivables and use the OC principle. Go to the receivables and use the OC principle. Go to the receivables and use the OC principle. OC means opening minus closing. Opening minus closing. Yeah, opening minus closing. If it's negative, you write it as negative 1863. Negative 1863 like that. Negative 1863. Opening minus closing. Opening minus closing. Opening minus closing. Opening minus closing. So I don't know which one will be easier for us. I don't know which one will be easier for us. Remember, I started by telling you that it will be very important for us to do what here, to always think over how do we save time in an exam? How do we save time in an exam? Yeah, how do we save time in an exam? That is the most important thing. The CEO for payables, OC for the others, for the other two like that. So you start with the CEO for the payables and then OC like that. And then, ladies and gentlemen, unless you have forgotten something, could you kindly come and now consolidate everything, please, from up there. Consolidate everything. Consolidate everything. Yeah, Sam MM is saying CEO is cool. Yes, because every minute in your exam counts. Every minute in your exam counts. Every minute in your exam counts. Making work easier, yes. Making work easier, yes. I don't know, this student here has not put the negative. Please, when you get a negative, if you want to rely on this formula, when you get a negative, you have to state it's negative. Because negative means it's a cash outflow. It's a cash outflow. I don't want to start reasoning. In an exam, when I'm in a vigilating exam, you're hitting your head. Is this an inflow? No, no, no. You remember CO versus what here? OC for the other two. Like that. Remember CO versus OC. $26,528. 26,528. 26,528 like that. This is now what we baptize as a cash generated from operations. Cash generated from operations. Cash generated from operations. 25. Is it 25? Is it 25 or 26? 26, 568. Sorry, 568. Thank you very much, because if we make a mistake, it will not reconcile. Thank you so much. Once you get the cash generated from operations, you'll be required to pay two things out of this. You'll be required here to pay tax and what here? Interest. So less interest paid, and the tax paid. You'll be required to take care of these two. So less interest paid, and of course you less tax that you are allowed, you are required actually to deduct interest paid and the tax paid from your operating cash flow. Now here we are. I would want in this case here a good student to tell me how much did we pay as tax. Let's start with tax. How much tax was paid in the period? How much tax was paid in the period? I'll be forced to rub this. How much tax was paid in the period? How much tax was paid in the period? How much tax was paid in the period? So we have here cash generated from operations. So we have here 26,568, and then we are required here to less. We start with tax. Doesn't matter really. Tax paid, and then we have here interest paid. If you wish, you can also pay dividends out of here, but nowadays dividends, according to IAS 7, they should go under investing activities and financing activities. So tax that was paid, I will need, ladies and gentlemen, an account. A lazy person uses the T accounts. I don't love them, but for we project. You can start with any. It doesn't matter really, Patrick. You can start with any. Now, ladies and gentlemen, I should have, in this case here, displayed the question first. So like you can see, taxation is under liabilities. So we have taxation 30/20 and 27/60. And then, of course, we have tax for the year. You can see tax for the year for 350. Ladies and gentlemen, remember in cash flow analysis, we are always interested in the movements, right? We are interested in the movements. So for tax paid, what I shall do for tax paid, just a moment. My mouse has refused. I don't know why it is refusing this mouse. Just a minute. I can't now be able to remove. Great. And I hope you guys are really following. That is the most important thing. You need to follow. Yes, mouse mazee na shida bwana. Mouse iko na shida. Ni mouse kule malizi pots. Hebu jaribu kucheza na hivi kidogo. Yes, you're the best. Thank you very much. Great. 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 Ladies and gentlemen, here we are. So for taxation, then what do we do? For taxation, what do we do? I can see it's a balance sheet item. So it's coming under liability. So I'll talk of tax payable. So I'll look at the both ends, the opening and the closing. So in this case here, we have amount brought forward. The tax brought forward. The tax brought forward is how much? The tax brought forward, ladies and gentlemen, is how much here? If you look at this question very keenly, the tax brought forward here, the tax brought forward for 06 is 2760. 2760. 2760. And then, of course, we have the tax which is carried forward. The tax which is carried forward into the next year. The tax carried forward in the next year is 3020. 3020. And then, ladies and gentlemen, of course, we have the tax for the year. The tax for the year is for 350. For 350. Tax for the year, what do? We shall debit the income statement and then we bring it to, it's a liability, right? So we have here tax for the year, so profit and loss. So profit and loss is 4360. 4360 or 50? 4350 like that. So from there, ladies and gentlemen, now I'll easily get the movement in form of how much was paid. So please come and balance. Is there somebody who can easily give me this total figure on the right? This total figure on the right, what do we have here? This plus this gives me what figure? This plus this gives me what figure? 4090, I doubt. 4090 is the answer. 7110. So 7110, this is also 7110. So when you subtract the two, then whatever you have here will go to the bank or the cash flow. The bank. So how much? I'm being told it's 4090. 4090. So of course I'm debiting this statement, I'm debiting this account and crediting the bank. So it is, ladies and gentlemen, tax that was paid. So tax paid here was what year? Was 4090, like that. Tax paid was 4090. So please go and do the same for interest paid. Go and do the same for interest paid. Go and do the same for interest that was paid. Interest that was paid. So to get the interest that was paid, it's so easy. Go to the liability section and see whether you have interest. There is no interest here, really. I'm so happy. There's no interest here. There's no interest obligation in the current liabilities. So how much was paid? So for purposes of you getting to understand this, so if it's interest paid, this is what I will do. Of course, in my subsequent class, I will show you how to go with this using shortcuts. So come here. So we have interest paid. So in this case here, we have a balance. In this case here, brought forward here. And then we have what is carried forward. For interest, there is nothing. What we have, ladies and gentlemen, is the interest expense for the year. The movement in between is the interest expense for the year, and the interest expense for the, it's an expense. I'll debit the income statement, which is the P&L, and then of course the accrued this account. So meaning that, ladies and gentlemen, for the interest paid is the same as finance cost. Interest paid is the same as finance cost. So interest paid is the same as finance cost, right? Which is what here, 400, like that. So in this case here, we have 400. So we have here 400. So then at the end of the day, ladies and gentlemen, what we charged our income statement here is what we ended up paying. So in this case here, we have interest paid. Interest paid was the entire 400. There is nothing which was carried forward. So this is, of course, bank. So come interest paid is 400, like that. So the two are supposed to be subtracted. So you subtract. When you subtract, what figure are we getting here as our net cash flow generated from operations? What figure are we getting, somebody? As our net cash flow generated from operations. So net cash flow generated from operations. So of course, I'll indent it a little bit and write it somewhere here. These are dollars thousands. These are dollars thousands. So what figure are we getting? Somebody here, somebody is telling me 22,078. Thank you so much. So that is the end of my operating activities. So should we stop this class, ladies and gentlemen, here and now? What will be your take home? What will you say have you understood out of these operating activities? What is that you'll never forget? Where are the low-hanging fruits? CO and OC, I love that. Great, 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 great. And then, of course, I'll always remember add back depreciation. Add back, in this case here, any finance cost. Subtract investment income. If there are any amortizations, etc., I'll always add them back in non-cash item. Right? Thank you so much. Thank you, Ryle. Always start with PBT. Ryle, I'm telling you, worry not the fact that right now the month is right at the corner. I would have given you a present. But please forgive me. The month is right in a very bad place. Right. Now, ladies and gentlemen, if you give me some few minutes, otherwise I can see people dropping off so seriously. If you give me a few minutes, ladies and gentlemen, here, I will be able to do what here to take you through. Right. I like what Infinix, you guys have really understood this thing. I've taught so many groups, but this group is special. You guys are really very receptive. Thank you so much. So, ladies and gentlemen, I would want to take you through straight away the investing activities. So investing activities, what do you think about investing activities? Very easy. Investing activities, for me, I have to keep on rubbing because my board is not enough. So investing activities, what are the kind of things that we should be able to capture? Investing activities, what should we be able to capture under this title, investing activities? Not many things really, very few things. Investing activities. Investing activities. What should we be able to capture under investing? Remember, we are also investors, right? It is basically the non-current assets. The non-current assets. I can see what Martin Kinguti is telling me. The activities which affect fixed assets. Yes, all of you are right. You're right. So investing activities basically are look at, in this case here, any proceeds, cash, from PPE disposed, right? Cash paid to acquire new PPE. This cash received, when you sell assets, you receive cash received from PPE disposed, and then we have cash paid to acquire new property, plant, and equipment. Wilfred, thank you very much. With the disposal of subsidiaries, of course, those are investments, but really, I would want to talk about group cash flow statement in our tomorrow's class. Today, I wanted us to just get the basics of CO and OC. Any other thing that I should be able to bring here? Remember, ladies and gentlemen, when we invest, especially out there, we shall receive dividends, isn't it? We shall receive dividends when we invest. When we are investors, we shall receive dividends. So we have here dividends received. Dividends received from our investments. Great. Right. Thank you so much. So, ladies and gentlemen, let's now get into business here and try to really get these things. This is the one that is a little bit technical because of the PPE account, So I would want you guys are very bright. I would want you guys to come and draw for us the PPE, the property, plant and equipment account. I can see non-current assets, they're here. Great, I love this. So the PPE account, I love this so much. The property, plant and equipment account, this is an asset. So any balance brought forward will come there. Any balance carried forward will go here, right? So this is what you need to do. PPE, it's an asset. So balance brought forward is here. Carried forward is here. Great. So we start with the balance brought forward. So the brought forward balance for this PPE is how much? It is 26,574 for the beginning year there. So this is 26,574. 26,574. And then we have, ladies and gentlemen, carried forward is 43,282, like that. Now, ladies and gentlemen, could you be very kind to your mwalimu tonight? What movements will affect the PPE within the year? What movements do we expect? What things, what items do we expect to affect our property, plant and equipment in the year? Either to reduce the figures, depreciation. So depreciation, of course, will be what here will be reducing, isn't it? So come and write here, depreciation. So have they given us depreciation for the period? Have they given us depreciation for the period? Have they given us depreciation for the period? Let's see. Yes, depreciation is 46.58. Thank you so much. 46.58. Thank you so much. So 46.58. Thank you so much. Then they are giving us something they are called disposal. We may dispose. So we have here disposal. So remember, disposal here should be the net book value of the assets that you disposed, not the cash. Don't bring cash there. It's net book value of the assets that were disposed. Let's look here. So we have, ladies and gentlemen, assets with a carrying value of 1974 were disposed. Carrying value is the same as what here? Somebody is the same as net book value. So 1974. Yes. 1974. So we come on top of 1974, the net book value, we put it there. Fortunately, here we don't have any revaluations, either upwards or downwards. So the only thing now that we have here, which will be able to affect our PPE, will be the acquisitions, the procured PPEs, right? So in this case here, we have in this case here the acquisition, the new PPE. So of course now this will be the balancing figure. So please give me this total figure first on the right side. The purchase, yes. So I'm being given 49,914. 49,914. 49,914. So this is what I'll also come and balance with here. 49,914. Thank you so much. So in this case here, what about now this? 23,340. 23,340. So this 23,340 is what we acquired in the period. So meaning that, ladies and gentlemen, our PPE increased, our cash went out. So this is cash out. Cash out. So then automatically, it can't be cash received from, this will fall here. Cash paid to acquire new PPE. So this is 23,300 what here? 40 like that. So are we together, first of all, up to there? Are we together? Are we together? Are we together? Thank you so much. From there, this is also somehow tricky, but very easy once you get used to this. The disposal, you need a disposals account. You need a disposals account. So come and do a disposals account, a small disposals account. So come and give us a disposals account. Very important. Disposals account. So disposals account, what do we have? The first thing we shall receive is this disposals figure from PPE. It was credited here, so here it should be debited. So I'll come and mention here property, plant, and equipment. Property, plant, and equipment, we have 1974. 1974, like that. From there, ladies and gentlemen, I know that my disposal should capture two other things: the gain or loss on disposal and the bank amount, the amount I received. In this question, they gave me, okay, in this question, they gave me a profit of 720, a profit on disposal of 720. So when I got this profit, who can give me the accounting entries for that profit of 720? Which two accounts will be affected? One of them, of course, is disposal. The other one will be what here, somebody? Debit, P and L. Omondi, no. With a profit. With a profit. With a profit, you can't debit P and L. Yes. Yes. We are supposed to, revaluation, no. No, we are supposed to credit the P and the L, and then we debit this account. We debit disposal with the profit. We debit disposal with the profit. So in this case here, debit disposal. So we have here profit of 720, and that is it. So meaning, ladies and gentlemen, that I'll be able now to get the bank figure here. The bank figure here. So could you kindly give me this figure? This plus this gives me how much? Right? They're not talking to me. They're not talking to me. I don't know who they have decided to talk to. I don't know who they have decided to talk to. I don't know. I don't know. $26.94. $26.94. $26.94. So this $26.94 will also come there. So automatically this is bank $26.94. So I'm crediting the disposals account with this, and then I debit bank, meaning that the cash I received from PPE disposed is 19 what here, somebody? Is $26.94, sorry. $26.94. Great, great. How about dividends received? How about dividends received? Dividends received from our investments, that must be the investment income. That must be the investment income. That must be the investment income. And because we don't have dividends received and our liability, our assets, current assets, we shall simply book that investment income the way it is. It was received that way. So then this is 180, I'm being told. So could you kindly transfer this amount there? Could you kindly transfer this amount to the other side? Transfer this amount to the other side. Transfer this amount to the other side. That is the total amount received from our investment activities. Don't forget cash paid. Don't forget to put this in brackets, cash paid. Don't forget to do that. Don't forget to do that. It's a cash outflow. It's a cash outflow. It's a cash outflow. So in this case here, investing activities, how much are we talking about? 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 They are not now talking to me. Remember, not everything, just these three. Just the three I put here. 20,466. Negative, right? Negative cash outflow. Thank you very much. Thank you very much. So ladies and gentlemen, I would want to do the financing activities, but I strongly feel right inside me that I've taught you so many things, which is against teaching principles. Don't teach so many things at one time. So it has been a pleasure hosting you tonight. I believe you guys have been able to fetch a few things here and there from this Mwalimu. And of course, because this was a free of charge class, I would want to take this opportunity to welcome you guys and be part of us. 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 Remember, you will just pay a fee of Kenyan shillings 3,500. 3,500, 3,500, 3,500, right? Per paper. We are quite a cheap, affordable college. Per paper, per paper, per paper, and then you should be able to join our classes. You should be able to join our classes. You should be able to join our classes right away. Our account pay bill. Pay bill is 402-956-9. Account number is your name. Is your name. Is your name. Account number is your name. Is your name. And perhaps for those students that I've never taught before who are wondering, this Mwalimu, does he also teach